Welcome to this explainer. Okay, today we're unpacking something huge. It's a topic that can literally save or cost you thousands of dollars. We're talking about international tax laws, and specifically what happens when you move back to India and your temporary tax honeymoon finally comes to an end. We're going to dive deep into the source materials today to build out your ultimate global tax survival guide. So, let's get right into it.
Think RNOR planning ends when your tax benefits end? Well, think again. See, many returning NRIs focus heavily on that RNOR period, but they completely overlook what happens after they transition out of it. And that's exactly what we're tackling today.
To really understand the stakes here, let's look at your chronological tax journey when you return to India. Let's say for the past 9 years, you were a non-resident, or NR. When you move back, you generally get this beautiful transitional period for the first 2 or 3 years. This is your resident but not ordinarily resident status, RNOR. But look at year 4 onwards. Boom! You become a resident and ordinarily resident, an ROR. The main takeaway? That RNOR phase is strictly temporary.
The contrast between these two statuses is actually quite jarring. During your RNR honeymoon, you've got this protective shield. Only your Indian-sourced income is taxed by India, so your overseas investments are totally safe. But the absolute second you cross that timeline into ROR status, it's a massive shift in how your wealth is treated. Suddenly, India starts taxing your worldwide global income.
And this brings us to a huge headache for RORs, the double taxation trap. Once India starts looking at your worldwide income, your overseas investments, things like US RSUs, foreign dividends, maybe rental income from a house abroad, they're suddenly caught in a crossfire. The country where the income is generated wants its cut, and now, well, India wants its cut too. Literally 2 countries trying to tax the exact same income.
So how do you avoid paying twice? Enter the DTAA, the Double Taxation Avoidance Agreement. This is a bilateral treaty between India and over 90 other countries, and it's designed specifically to prevent this exact trap. Think of the treaty as a referee. It allocates the primary taxing rights between the source country and your residence country, offering relief so your wealth isn't getting double-dipped. But of course, there's a catch. To actually claim any of those amazing DTAA benefits, you absolutely must have one golden piece of bureaucratic proof. You need a Tax Residency Certificate, or TRC. This is the official government document confirming that you are, in fact, a tax resident of a specific country for that financial year. Without it, foreign tax authorities will just shrug and charge you their maximum default rates, completely ignoring the treaty. Okay, so how do you actually get your hands on this Indian TRC? It's basically a 3-step pipeline. Step 1, you have to prove your Indian residency under Section 6 of the Income Tax Act, which is based on your physical days in the country. Step 2, you submit an application, that's Form 10FA, online via the e-filing portal. And finally, Step 3, your assessing officer verifies your details and issues your official TRC, which is known as Form 10FB. And remember, you've got to do this every single financial year you want to claim those treaty benefits. Now, why go through all that paperwork? Let me give you a concrete number. 30%. If you hold U.S. stocks and receive dividends, the U.S. IRS is going to automatically slap a painful 30% standard withholding tax on that money if you're a non-resident of the U.S. That is a massive chunk of your investment return gone before it even hits your bank account. But if you present your TRC and leverage Article 10 of the India-US DTA, check out how that withholding rate drops instantly down to 25%. So instead of paying $30 on a $100 dividend, you only pay $25, leaving you with $75 instead of $70. It might seem like small potatoes on $100, but scale that across a large portfolio over several years, that's a massive amount of money staying right where it belongs, in your portfolio.
So you're probably wondering, how do you unlock that 25% treaty rate for U.S. investments? Well, on the U.S. side, it's actually surprisingly simple. You just submit a Form W-8BEN to your U.S. broker. You provide your Indian PAN on this form to essentially self-certify your Indian tax residency. Now, your broker might just accept the W-8BEN and leave it at that, but you still absolutely must keep your Indian TRC, that Form 10FB, in your records, just in case the IRS or Indian authorities ever decide to audit you.
All right, so you've successfully reduced the tax taken abroad. But remember, India still wants to tax that global income because you're an ROR. This is exactly where the Foreign Tax Credit, or FTC, comes into play. An FTC basically allows you to take the tax you already paid overseas, like that 25% in the US, and use it as a credit to offset your Indian tax bill on that exact same income. It ensures you only pay the higher of the 2 countries' rates, not both of them combined.
Now, I want to warn you about a trap that so many people fall into. It's called the gross-up rule. Let's say you received that $75 net dividend after the U.S. withheld $25. Well, when you file your Indian taxes, you don't just declare the $75. India actually calculates your tax liability on the full pre-tax amount of $100. You have to gross up the income before they allow you to apply your foreign tax credit.
And speaking of claiming that credit, there is a massive compliance shift happening right now. Up until financial year 25-26, returning NRIs claim their FTC by filing a pretty well-known document called Form 67. But starting in financial year 26-27, the rules completely change. The old Form 67 is being completely scrapped and replaced by a brand new Form 44 under Rule 76.
This is absolutely crucial to understand because there's a huge catch with this new Form 44. It introduces a strict new requirement, mandatory chartered accountant certification if the foreign tax you paid equals 1 lakh Indian rupees or more in a given year. The days of just easily self-filing large foreign tax credits? Yeah, those are over. Getting professional advice is now pretty much a mandatory step in your compliance journey.
Now, here's a surprising and incredibly helpful little nugget from the source material. What if you had a tax dispute abroad and you finally managed to settle it years later? Well, under the new rules, you can actually file Form No. 45 within 6 months of settling that foreign tax dispute. This lets you retroactively claim your previously omitted foreign tax credit in India. It is a fantastic safeguard for those really messy, complex international tax situations.
Oh, and a quick technical note that you absolutely must get right. When you're converting those foreign taxes paid into Indian rupees for your FTC claim, you can't just use whatever exchange rate pops up on Google. No way. You are required to use the SBI TTBR. That's the State Bank of India Telegraphic Transfer Buying Rate. And specifically, you have to use the rate from the last day of the month preceding the month the tax was paid or deducted. I know, it sounds super pedantic, but getting it wrong will mess up your entire claim. All right, let's take a breath. What does your action plan actually look like? We've talked a lot about what happens when you become an ROR, but honestly, the most important phase is right now, before your RNOR status expires. You've got to act with some serious urgency while this tax window is still open.
Do not forget about your RNOR superpower. While you're in this phase, capital gains on foreign shares, foreign mutual funds, and overseas real estate are completely 100% exempt from Indian tax. It is a massive, temporary advantage that literally vanishes into thin air the day you become an ROR.
So here is a concrete checklist of actions you should consider before that deadline hits. Number 1. Take a hard look at your portfolio and consider liquidating high-gain foreign assets to lock in those tax-free gains. Number 2. If you've got employee stock options, or ESOs, this might be the absolute perfect time to exercise them. And number 3. Think about distributing foreign pension balances if that lines up with your long-term goals. Do this before ROR worldwide taxation kicks in and takes a huge bite out of your hard-earned gains. As we wrap up the nitty-gritty details, I have to give you a very stark warning about Schedule FA. Listen closely. Once you are an ROR, you must strictly and exhaustively disclose all global bank accounts, financial interests, and foreign properties on Schedule FA of your Indian tax return. Do not ignore this. Failing to report offshore assets falls under the Black Money Act. We're talking incredibly severe penalties, massive interest, and even prosecution. Compliance here is totally non-negotiable. The transition back to India is about so much more than just a temporary tax break. You have to be proactive. See, many returning NRIs focus on the RNOR period, but overlook what happens after they become resident and ordinarily resident. Once that happens, India generally taxes worldwide income subject to the Income Tax Act and applicable tax treaties. If you receive dividends, interest, or other investment income from overseas, you'll also need to understand how foreign withholding taxes and double taxation avoidance agreements work. In many cases, you'll need to establish your Indian tax residency, maintain the right documentation, and claim treaty relief or foreign tax credits where available. The exact process depends on the country you're investing in, but planning before RNOR ends can make future compliance much smoother. I'll leave you with this final thought to take away today. RNOR ends, global tax planning begins. Are you ready for your next phase? Thanks for joining me on this explainer.